Our dividend income portfolio is almost double the market return so far, a 16% return in just 1 month in. One stock is up 47%, and I'm adding another investment that could go even higher. In this video, I'll review the portfolio and reveal a critical piece in your investing strategy. We're talking dividend investing today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I started the 2019 Grow Your Dough Challenge just last month, and our portfolio of dividend stocks is already exploding higher. I'll update you on the portfolio, including 2 stocks I took gains on, as well as a favorite new name I'm adding. More importantly though, I'm also going to be talking about a crucial piece of your investing strategy. Now, selling is always a tricky subject for long-term investors. You have to be careful not to sell your winners and hold on to your losers, but those rebalancing rules I'll show you are going to be critical to producing those returns that will beat your goals. This is something we talked about last week in that video on the 5 reasons professional investors use to sell stocks, and it's something that most investors just get wrong. So make sure you stick around after the portfolio review for those rules. I'm putting this video into our 2019 stock market playlist, so if you haven't seen those other 2 videos, check those out. Along with some of the biggest investing channels here on YouTube, I created a $1,000 portfolio in January and will be tracking it all year long. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and then automatically invest any new deposits across that group. Unlike some of the other investing apps, M1 doesn't charge a monthly management fee, which is why I'm using it for this no-cost investing strategy. It also has retirement accounts available, something Robinhood doesn't have, so that's important anytime you're investing in these high-yielding stocks that pay dividends. Now, I don't want to spend too much time talking about the challenge because I really want to get into those massive returns in our dividend income portfolio. Make sure you check out those first 2 videos to see how I'm picking our dividend stocks and the first 10 names in the portfolio. So here's the portfolio as of last Friday with a 15.8% return on some really blowout numbers on some of these picks. We'll go over each of the 10 dividend income stocks in the portfolio, one with a 46% return already, as well as a new dividend stock I'm adding. Just 1 month into the year, our dividend portfolio is just under twice the return of the broader market here with the S&P 500 and is more than twice the return on the Vanguard Dividend Appreciation Fund. But let's look at those individual stocks in our portfolio because some of these have just boomed higher. 8 of the 10 dividend stocks are beating that 7.9% return on the market, with only the Alerian MLP, ticker AMLP, and the iShares European Financials Funds, ticker EUFN, lagging the market return. I still like these 2 dividend funds. First, because they're giving me that broad diversification in high-yielding energy assets with those master limited partnerships and with those international financials in the European Fund. Also, though, because I still think these are great contrarian themes. Those MLPs own hard assets that pay a hot 8.2% dividend yield. Oil has been battered down to about $50 a barrel, but is finding support, and I love the theme. For more about why I invest in these high-yield companies, I'll leave a card up here in the corner of the video about why they're some of the highest paying dividend stocks you can find. Now, that European Financials Fund is 30% off its highs, and nobody is expecting anything but chaos this year from the theme. I think that's overblown, and the fund pays a 6% dividend yield with banks selling for bargain prices. Now let's look at some of the winners, and I know half of you are already opened up a new internet window to check out Hanesbrands and Bank OZK. Hanesbrands blew away its 4th quarter earnings last Wednesday for exactly the reasons I pointed out in our last month update. Strength in that activewear category and the direct-to-consumer sales. Higher profitability direct sales were a bigger chunk of the total, and revenue from activewear beat estimates by 7%. Now, I did take some money off the table on Hanesbrands. We'll talk more about how to decide when to sell and rebalance after the review, but specific to the company, there were a few reasons. First is that after almost a 50% jump, the price was pretty close to my estimate for fair value. 4th quarter numbers surprised Wall Street, but activewear has a contract with Target expiring early next year. I still think there's some upside, and I don't want to totally abandon the stock, so I sold out of the profits and will use that to buy into our new investment. I also took profits out of our Bank OZK investment. The bank also reported stellar earnings last month, and I still like the valuation, but the dividend is now just 2.6%, and I wanted to use those profits to buy into our new stock. To reiterate here though, I'm still in both of these stocks for about the same amount as when we started last month. I just think the bulk of the upside is probably out, so I want to keep riding it higher while I limit the downside by booking those profits. Elsewhere in the portfolio, chemicals maker Olin, ticker OLN, and China Life Insurance, ticker LFC, are both producing 16% returns. Again, if you haven't watched that video on why I think this could be a once-in-a-generation opportunity for some of those Chinese stocks, check that out. China Life issued a huge warning on profits late last month, and the stock is still up 16%, so that tells me the bottom might be in on these names. Our Vanguard Real Estate Fund is doing really well with just over 12% return, and I love this REITs theme. Not only on that 4.25% dividend yield, but just the idea that the Fed rate hikes might be on pause this year. REITs in that commercial real estate space have struggled over the last couple of years on higher interest rates, but this could be the year they break higher. Now I want to get to that dividend stock we added and how to know when to rebalance your portfolio, so I'm going to wait to update on those other stocks in our March update. Make sure you click that subscribe button so you can track the portfolio each month, because it looks like it's going to be a market buster this year. So if you watched how I put the portfolio together in our first 2 videos, you know I love these beaten down stock plays. It's a dividend portfolio, so I set a 3% yield requirement, but I love to go after those best-of-breed companies that investors have abandoned. As we saw with Hanesbrands and Bank OZK, these deep value stocks offer huge upside returns along with those dividends. ConAgra Foods is a U.S. powerhouse in prepared meals, where it's the second largest in the industry. It has a 40% market share in canned tomatoes and more than a fifth of the meat stacks market with its Slim Jim product. The company has some solid brands in that relatively safer consumer staples sector, so we're talking dividends as well as protection from the economy. Now, management fumbled big time with last year's Pinnacle acquisition and had to lower the profit outlook by 20% late last year. The problems were centered around Pinnacle's distribution business, so a little harder to read, but management has been very transparent since December about its plans going forward. I think they're being overly conservative on estimates for a 5% sales decline and margin loss on the Pinnacle assets, so the next surprise could be to the upside when things come out better than expected. Shares of ConAgra pay a 3.9% dividend, which management has affirmed with its new 2019 outlook, and trades for just 9.9 times trailing earnings. That's a 41% discount to the price multiple where it was trading in November. Cash flow is still solid, and management is expecting a $215 million in cost savings through 2020 on that acquisition. The average analyst price target is 50% higher than the current price, and even the lowest price target is 8% higher. Now I want to talk about why I sold off some of our stocks, because it's a very important topic that most investors really don't understand. Even for long-term buy and hold investors, you have to follow your stocks. If you're not ready to spend a little time watching for those 5 warning signs we talked about in that previous video, then you're better off just investing broadly in ETFs and don't worry about stock picking. It's not a matter of holding or selling all of your position. That's what a lot of investors get wrong. They think it's an all or nothing kind of idea. You either love a stock and ride it higher, or you sell out of the investment. You see here that I'm still holding Hanesbrands and Bank OZK in the portfolio, even though I sold off some of the shares back down to our original investment. This is called rebalancing, and there are a few reasons you want to do it. First is that no individual company should be more than about 5% of your total wealth. The risk is just too high that something unforeseen happens to that company and it could destroy your portfolio. I know it looks like these stocks are between 7 and 12% of the portfolio here, but they're actually a very small part of my overall wealth. Remember, I've got investments across 5 different websites, so these are just the percentages of these stocks in the M1 platform. Nevertheless, that 5% rule is extremely important, and I've seen lives destroyed over this. Everyone likes to talk about that dollar cost averaging strategy and buying more of an investment as the price falls. What can happen though is that you chase that stock down, adding more and more, just hoping that it rebounds a little and that you can break even sometime. Pretty soon you've got 30% or 50% or more of your money in this one company, and it never gets back up. I've seen it happen with friends investing in coal companies around 2015 and in some tech names. Now, you also might rebalance your stocks on valuation. Every time you buy an investment, you need to have an estimate for what it's worth. Now, that can be based on some simple measures like price to earnings or cash flow analysis. Whatever it is, though, it's what the fundamental business measures say the company is worth. For example, while Wall Street analysts were climbing over each other to downgrade Hanesbrands on the way down, my own analysis of the activewear segment and direct sales told me that the shares were worth at least $20 each, and that was confirmed last week with a 20% pop to almost $19 a share. And I still think there's some room for upside here, especially as everyone piles into the good news, but I wanted to take some of my risk off the table as we get closer to that fair value. One more reason for rebalancing the stocks in your portfolio is just to keep your money from being overexposed to one particular sector. Now, this wasn't so much the case with our dividend portfolio, but say your stocks in technology companies have been surging lately, and adding up the percentages you have in these tech stocks is like 20% or more of your portfolio. Here again, just like having that 5% rule on any individual stocks, I think you should limit any particular sector to less than 15 or 20% of your portfolio. This is also why I don't recommend investing in that broad market fund. For example, the S&P 500 ETF, or ticker SPY. This one owns all the stocks in the S&P 500. Now, I know a lot of passive index investors love the fund, but if you look at what you're actually getting, this fund is always 20% or more in tech stocks, with almost half the fund in just 3 sectors of the economy. Like I talk about in our goals-based investing course, you need to diversify across different sectors of the economy that are going to react differently to inflation and growth. It takes a lot of the risk out of your money and makes for a much better portfolio. That 15% return is a great start to our 2019 stock market challenge, but I gotta tell you, some of these other YouTubers are giving me a run for my money. What's great about this year's stock market challenge is that we've got 14 other YouTube channels participating, all taking a different perspective on investing and tracking their portfolios for the year. Now, I've started a playlist with all the Grow Your Dough Challenge videos, and I'll link to that in the video description below. You've got some heavy hitters here like wealth hacker Jeff Rose and Tila Holcomb investing in stocks. We've also got fellow Marine David Perry of Military to Millionaire. He's doing a flipping strategy that is intense, so make sure you check out that playlist for each of those channels. Now, I'm linking directly below the video to those first 2 videos detailing how I set up our dividend income portfolio and how you can set up your own challenge. I'll also leave a link to M1 Finance, that no-cost investment platform that I'm using for the challenge that's going to save you all those fees whenever you go to rebalance. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments below. We'll make sure you get an answer in a future video.